Typically what we see in the New York lunch hour, whatever move the kind of market was making prior to the lunch hour, normally either tends to consolidate and or go the opposite direction. So if we could say, the majority of the move, the bigger move today was down, we're looking for that consolidation sideways and or some type of dead cat bounce. Now, I've got a few levels marked out on my screen. I'm not sharing my screen right now because I've got to tie it into the software. I didn't set it up that way. So you can kind of just follow along. Right now, what I'm looking at is a 1 hour time frame. What I'm looking at is overnight session highs and lows. Okay, so 17,930, that's the overnight session high. 17,864 roundabout is the overnight session low. Okay, from there, what I'm looking at is the first hour candle range. Okay, I call it the opening range. What it really is just the 30 minutes after the market opens. So market opens at 9:30. From 9:30 a.m. to 10 a.m., that's that first 30 minutes after the market is opened. But what I do is I take that entire hour. Okay, so what I'm going to do is go from 9 a.m. New York time to 10 a.m. New York time, and I want to see what is that opening range. Okay, so for me, I've got it at roundabout, again, because I just dropped price levels on there. I don't have it to the exact T, but you guys kind of get the idea. I've got first hour range sitting at 17,950. I've got the bottom of the range at 17,831. So if I look at where I'm trading at right now, currently it's 9:14 in the morning here in California. So at this current state, we are trading smack dab in the middle of one of two things: overnight session highs and lows, as well as that opening hour range break. So anytime I'm looking at price action that's trading in the middle of the range, where we don't really have any trending follow through to the upside, no trending follow through to the downside, any type of setup that I'm going to be looking at here on a 5-minute time frame or even a 2-minute time frame, I'm treating as scalps. Now, there was a better portion of this morning, for a good hour to 2 hours, where the market essentially was going sideways. You were getting some closes up over the 20 SMA, back down, below, back over, back down. Now we're currently in an active 20 play long here. Okay, this play started, it's set up at 8:55 Pacific Standard Time. It confirmed at 9 a.m. Okay, so it confirmed at 9 a.m. It pushed right into the 200-day moving average on a 5-minute time frame, stopped there. In the last 15 minutes has broken over that 200-day moving average on a 5-minute time frame. So if we look at a couple of things, if I look at the range, okay, if I look at the range on the reason why candle that closed over the 20 SMA, that range is 15 points. Okay, so automatically we can do one of two things. We can look for a 15-point scalp, which is a 1-to-1. If we're going to risk that candle, meaning we're going to risk 15 points, let's look to make 15 points. Okay, now the high price was sitting at 17,890, and this current candle has traded up to a high price of 17,905. There's your 15 points, right? So if you're looking for that 1-to-1, you should be considering taking profits here. The only other way that I would recommend to take profits is take the ATR. Okay, so take the ATR or take that range of that candle and cut it in half. So if the range of that candle is 15 points, cut it in half. Let's call it 7-8 points. If you manage to get 7 or 8 points off the scalp, take your profits. Now you do have the traders that are looking for more, right? Maybe you're trading a little bit smaller size. I'll give you an example. If I'm trading one micro contract and I take 7 points, I'm going to make 15 bucks, right? Is it life-changing money? Of course not, right? It's not. If you're looking for a bigger move, right? And let's say, for example, you're trading 2 micro contracts, then maybe you lock in profits on one of those contracts at $15, $20, and you let the other one go, right? You just let it go until it starts to stall and stop out, okay? Or you use break even as a stop. So in this particular situation, what I would be looking for, I'm going to give you guys an example of if I was trading multiple contracts, and let's say I just took some profits off at 7 points, I took some profits off at 15 points, so forth and so forth. The next area that I would try to be targeting is a previous swing high, which goes back to 7:30, 7:35 a.m. Pacific Standard Time. If you look at those candles, goes back to that 730, 735 candles, that's going to be your previous swing high. And or I'm looking for overnight session highs 17,930 as my next major supply zone. Okay, anything over 17,930, I'd be looking for 17,950, and that's how you would let that running contract go. Again, only going to work if you're playing small size, right? You're playing 2 to 3 micros, you're taking some points off at 10 points, 15 points, and you're kind of just letting the remaining contract or two run until it gets there. And if it never makes it there, that's the name of the game. Either we use a break-even stop, or you can use your original stop loss, so forth and so forth. But again, we never want to, go positive and then give everything back in hopes of, catching a winner, right? A running winner. It is what it is. Other than that, this range here, until, in my opinion, until we get over overnight session highs in that opening range highs of, let's call it 17,930, 950, until we get over that, treat everything as a scalp to the long side. It's just a continuation of this dead cat bounce, which all in all, if you really look at it from the market open into where we're standing at currently, it's just a big bear flag. So we could just be, waving to the sideways a little bit up, and then you might get that breakdown. Now, if we start to lose the overnight session lows again, 17,864, we've already put in kind of a higher low. That higher low came at around 8:30, 8:35 Pacific Standard Time. Correlate that to the time zone that you guys are trading. But around 8:30, 8:35 a.m. Pacific Standard is when we got that higher low. Okay, so we got our first initial leg down off the open. We got a little bit of our first dead cat bounce, created that lower high. Then we put in our next little, tried to make that second attempt at putting in that second leg, and then came up short and made that higher low. So with that being said, great opportunity to bounce. For those of you guys who are in the room, maybe newer, I'm going to post this video up. Some of you guys may hear the term, Biggs bottom or Biggs top. It's just a mean reversion trade, right? One of the members in our room, Biggs, he's very, very good at trading these type of reversals, these mean reversions. If you want an example of what a, Biggs bottom, Biggs top, or just a simple mean reversion, how to catch the dead cat bounce or vice versa early, I want you guys to look at the candle of 8:35 Pacific Standard Time. So again, look at 11:30 Eastern Time or so forth. If you're Mountain Time, 10:30, whatever the time is. But 8:35 in the morning, look at that candle. That's your reason why. That's telling you potentially we could be looking at a short-term bounce. Now, why is that? We're getting no follow-through through the original low of day, through that original opening range break, right? Through that first leg down. And it's a indecision candle. It's a hammer candle. There's not a lot of follow-through there. What you would be looking for is identifying the 8:35 a.m. candle, using that one candle as a hard stop loss. So if we do close below that, we're going to get out. You then look at the range. It's a 14-point range on that candle. You would be looking for a following candle to take out the high. Okay, that happens at 8:40 PST. So at 8:40 PST would be the candle that you're getting into. It's also in confluence with getting back inside the range of the overnight session lows. And it's driving into the 20 SMA, and it has a 200 SMA sitting above. So that's kind of how you identify that move very early, very quickly. And again, if you do take a trade like that, you're not expecting us to go through high of day and trend all day. You're just looking for a little bit of a move. So if the range is 14 points, if you can manage to squeeze out 10, 20, 25 points on a move like this, it's fantastic, right? All you need to really do is make sure you protect yourself with the risk. Obviously, again, sometimes these plays work, sometimes they don't, right? I don't know how many times I've been in some of these trades where it looks great, it looks like we're ready for some type of bounce or some type of reversal, and then 2 candlesticks later it's punching through the lows. Again, that's the name of the game as well. The only way to kind of protect yourself is to limit the amount of contracts that you're trading. You don't want to get trading outside of your means, of course. But other than that, as the day continues here, price action will continue to slow down. You might get one more move coming out of lunch, Typically it's going to be either testing of one of those two ranges, since range high or low, since we have not broken out, right? Now, if we were broken out to the high side, or we've broken down to the downside, then I would expect a move to test that level that we broke down from or broke out from, and then continue. But since we have not taken out any of that opening range yet, we could get a push towards one of those sides, and if not a breakthrough. So typically, what you would want to be looking for in a situation like this is when you're trading inside the middle of the range like this and you're taking these scalps, make sure you're cutting that reason why candles range in half, taking profits sooner, cutting your position size down in half. The last thing you want to do is trade full size, your normal full size. Again, everyone's full size is different, but the last thing you want to do is trade full size when the market is not trending, if that makes sense. Yo, what's going on, buddy? Somebody say something. But anyways, that's where we're at right now as it stands. Again, if you kind of look at your chart on a 5-minute time frame, right now we've broken above that 200 SMA, and now we're kind of pulling back, right? So that 200 SMA has been a little bit of a troublesome spot on the 5-minute time frame, kind of going back to the original breakdown. If you look at the previous 5-minute candle here that just closed, indecision candle, right? Could it be a start of a reversal candle? Maybe, right? Anytime you get those little cross-haired candles there where, you've got equal amount of wick on both sides into a level of supply, into a level of demand, could be indicating either it's a pause candle for a next major push up, or it's signifying that there's a rolling top coming. So if one was long, right? If one was long now off this bounce, you want to take your profits. Now, a problem that a lot of traders run into is, let's say you were in a long position, right? We're going to use theory talk here. Let's say you were in a long position here, either off the 20 SMA bounce or the mean reversion that came off of the hammer candle earlier that we just discussed. Let's say you take profits here and the market continues to push higher through the opening range break, the overnight session highs. And then you sit back and you think, well, I lost out on a bunch of money, right? I missed my opportunity. I was already in that move. And then you start to chase that move later, right? You have to look at it as that's not your money. Your trade setup is to trade between supply to supply, demand to demand. So if you think about it, in theory, holding a trade as it's breaking or coming into a level of supply, in this case long, holding a trade and selling into that is your trade. That's your money. Now, it's your prerogative if you want to hold longer than that to see if you can squeeze out some extra points. However, if you miss that move, let's say, for example, we make a push up towards those overnight session highs, you can't look at that as a missed or lost opportunity, because that's a new entire setup. So, for example, I'll give you a quick example. Now that we've broken over this 200-day moving average on a 5-minute time frame, we've put in a couple new highs here. If one wanted to take this long position, there's a new long position over the 9:15 a.m. Pacific Standard Time candle. That price is sitting at 17,905. Okay, if you want to go long because we've cleared out that 200-day moving average, then you can go ahead and push your chips to the middle of the table and take a long position over 17,905. Now, what that does, I have no idea, right? Because any setup is just a setup. Nothing is ever guaranteed, is what I'm trying to say, right? The only thing that's guaranteed and the only thing that is secure is how much money that you're risking based on the number of contracts that you're playing and where's your stop loss, right? So on something like this, you could use multiple, things as a stop loss. You could use a stop loss below the low of that candle, which is 17,896. So you'd be risking around 10 to 11 points. You could use the 20 SMA as a stop loss. You're going to be definitely risking closer to 20 to 30 points on that. Or you can use a previous 5-minute candle after your entry. So there is no right or wrong way to set your stop loss. but make sure that your stop loss is set around a technical level. Now, I'm just giving that particular scenario. I'm not saying that I'm going to jump into this long position if we clear out the 17,905, but I'm just saying that's one way that you could look at it. And a price target that you would try to be targeting would be the previous swing high. Again, going back to 7:30, 7:35 a.m. Pacific Standard Time high candles, which is 17,916. So is there even a lot of space, right? From 905 to 916, you're talking about 10 points, right? So if you can manage to squeeze 10 points, fantastic. And if it continues to push over that, then the next price target is going to be the overnight session high sitting at around 17,930. So I hope that kind of makes some sense, right? Again, we're all looking at the same charts. We're all analyzing the same price action. Your thesis and your technical analysis should not be that far off from the next guys. It's just all about if the market's going to confirm, and if we knew, right, like let's say, for example, if I knew 100% that if we clear out this 17,905 that we're going to jump up 10 to 15, 20 points, I would go all in, right? I'd take the max size, I'd go all in, I'd take my 15, 20 points because I know it's guaranteed. Again, trades are not guaranteed, right? All we have is the technicals to kind of use as our edge. So manage yourself accordingly, right? Manage yourself accordingly, protect yourself. And no trade is ever 100% secure, so that's why you have to manage the number of contracts you're trading. Again, for some of you guys who are trading on the prop firms, depending on the account size and depending on the balance that you have, I would definitely always recommend to start off trading those micros. Between 3 and 5 micro contracts, you can make great money, okay? You can make great money trading 3 to 5 micros. You can still limit your risk and you can protect yourself. In the beginning, whether you're on an evaluation account or you're in a funded account, the first week to 2 weeks is the absolute grind. The first, I would say, honestly, the first few weeks is a grind. Why it's a grind is because you have to build that cushion. You have to build that padding. The worst thing is to go in there oversized as we're taking out the 905 now. But the worst thing that you can do is over trade, over leverage yourself on day 1, 2, 3, week 1, and go down $1,000, $2,000, and then have to crawl yourself out of that hole because you're trying to pass this thing in a day or two because you're trying to get paid out on the first week. It doesn't make any sense, right? It doesn't make any sense. If you look at this current candle went up to 913, and we were talking about the previous swing high being at 915. So we came up 2 points shy. So do you see how that kind of works? It immediately swept that previous swing high area by 2 points and came back down. Okay. So again, if someone was to get in over 905 and it went all the way up to 913, you only got about 7 points on the move before it quickly came back. But the thing is that newer traders or inexperienced traders who are not knowing what to look for are still stuck in this position long, right? Now, when you take trades, especially scalps, in the middle of a range, you 100%, before you even click buy or sell, depending on if you're going long or short, you have to have a plan. What are you looking for, right? How many points? If one was to tell me I'm in long over 17,905 and I'm targeting 930, right? 17,930, which is the overnight session highs, until stop loss or it tests 930, then great, then you're still in this trade. If your intentions were to scalp it and you're scalping the previous swing high, or you're scalping half that range of the candle, if the range is 14 points, you're looking for 7 points, then when you get 7 points, 8 points, you need to sell. It doesn't mean, oh, hey, I just got 7 or 8 points. Let me see if this continues higher. That was not your plan. Many traders fail, and many traders have a hard time is because they deviate from their plan. Right? For some of you newer people that have joined the room, maybe you've been here a week, maybe you've been here a couple weeks, maybe you've been here a month. Has there been a day, and today hasn't been a great day besides the opening move here, like off the open, that short position? There hasn't been a lot of, really good moves, but since you've been here, since you've been watching the market, has there really been a day, whether the market has been great or not so good like today, Has there ever been a day where there hasn't been at least one or two setups? Right? I really want you to think about that. Have you watched the market and there realistically through back testing or looking at the market or watching the market or trading the market, could you realistically say that there has not been a setup, right? Every day is going to provide an opportunity. The point I'm trying to make is that many times traders try to rush through things, make up different ways to trade, make up invisible, thought processes and ideas about where the market is going because they're in fear of missing something, right? Like I'm watching the screen, so I should be making money. It's not about that. You can make up a week's worth of P&L in one day, right? Just like you can give back a month's worth of great profits in one trade, right? So the point I'm making is that the longer you sit here and the longer you execute things the way that they should be done, meaning allowing the setups to come to you, having a plan when you enter and exit the trade, right? Like, where are you going to exit? Where do you want to take profits? There is no, well, the market looks like it can be going higher, so, maybe I go higher. Well, I don't think that the market can go any higher, so maybe I'll short here. And no. When you're trading, especially scalpers and day traders, we're not long-term investors. We're not swing traders. We don't care about the fundamentals. We don't care about the catalysts. The news doesn't mean anything. We need technical triggers to enter and exit trades. It's all technical. So getting into any trade, you have to 100% have a plan. What is that? What is the reason why we're taking this trade? And if it didn't work, are you upset about it? Many times people that get upset about losing trades is because they had no plan going into the trade. And the traders who have a plan going into the trade can generally brush off a losing trade a lot easier because A, they already knew how much they were going to lose if this thing went sideways. And B, you understand that every single day you're given an opportunity to take a trade. I've been doing this now for 9.5 years. It's going to be 10 years now in the summertime. Between trading equities, options, futures, and everything else in between. Every single day the market is doing something. Every single day people are making money in the markets. Because if you weren't, there would not be a market. That's why it's called a market, right? There's somebody on each side of the trade making money. So maybe we don't see things clearly some days. Maybe the market doesn't cooperate with us the best some days, but it doesn't necessarily mean that we can't come in and make money. So patience is definitely going to be a big key. Patience is definitely something that everyone needs to work on. Discipline, patience, being okay with the outcome, because it's something that we have no control over. We don't have any control over the outcome of any particular trade. I think one of the most important things to do is having realistic expectations, on the outcome is realistic. Like, if you're trading 3 micro contracts, what is the realistic what is the realistic, outcome that you're going to make, or probability that you're going to make $2,000 trading 3 micros? Is that realistic or not? Right? Sometimes people are taking trades and it's like you're not even being realistic on what's the potential damage. And it goes the same way on the loss side. Someone jumps in 2 or 3 mini contracts, because they see others doing it, making 400 here, 500 here, have no idea, that this thing shifts against you 10, 12 points in a blink of an eye, and you could be down $1,000, right? So have a realistic expectation, and that puts things into more perspective. And I'll just throw out a note for everyone out there who's trading prop firms. Listen, guys, if you're trading a prop firm, you have a little bit of an advantage that can hurt you over someone who's trading personal capital. Someone who's trading personal capital, every time they take a $50 loss, a $100 loss, a $300 loss, You know, $400 loss on a $1,000 account, $2,000 account, $5,000 account is a big blow. You know, when you're trading prop firms and you have essentially unlimited amount of leverage and you can make 100,000 day trades a day, you don't have and grasp the full concept of money management. So treat the money in the prop firm as it was real money. Okay. Don't just look at the potential outcome of how much you can make, but look at when you do take those losing trades, if it was real cash, right? Like, let's say, for example, you have a $50,000 account for one of these prop firms and you have a $2,000 or $2,500 drawdown, right? Depending on the firm. If you take a $500 loss today or a $300 loss today, well, put yourself in the scenario, in the shoes, if that was only a $2,500 personal account. That's a big blow, right? How many days can you essentially do that before you're out of business, essentially? You know, losing $200, $300, $400. Essentially, you know, within a week's time, 7 to 10 days, you could potentially have a blown account. And what are you going to do? Load up another 2,000? So, you know, I get the whole point of, you know, well, it only cost me $20 or it only cost me $50 to get this evaluation. I get it. But do you want to do things right and stay in business, or do you want to just filter through these things in hopes of passing? And then it doesn't really matter, because once you do pass, you brought in so many bad habits that you're going to continue to do the same things and continue to lose and blow accounts. Treat it as real capital. Like, if you guys take a $200 loss, $300 loss on the future side of things for a prop firm, it should sting. It should sting. You should not be looking for more trades down $400, $500, $600. You should focus on trying to create a good trading routine, allowing your brain to reset itself and coming back tomorrow. Gosh, how about Tesla just absolutely ripping today? Absolutely ripping. I had $170 calls last week. I don't even know why Tesla popped so much today. Was there? Is this just a continuation from earnings, or did they drop some news? Does anybody know that? Little back test here of the 200-day moving average on a 5-minute time frame on NQ. One could call the 9:30 a.m. Pacific Standard Time candle a reversal candlestick here on the NQ. Profit taking, if someone was short looking for a scalp, would be down here closer to the 20 at 17,886. But again, market's been extremely choppy. It's not the best time to be guessing, right? Oh, let me take this long here. Let me take this short here. Let me take this long here. Oh, nice. They got a partnership. Great. So, you know, again, and this is another thing that a lot of newer traders, they fall victim to. They take a long, they try to take the short, they're looking for the long, they're back short. It's like, guys, at that point in time, if trading is a game of probabilities, nothing more, because nobody knows the potential outcome of each potential setup. Again, if anyone is short here, please take profits into this 17,885, 17,890. Since you do not know the outcome, the more trades that you take, there's your profit taking if anyone was short. If the more trades you take, okay, the more trades you take, the higher the probability that you're going to have some losers in there, okay? So if you manage to start the day, I don't care if you make $50 off the open, you make $100 off the open. Is it life-changing money? No. But if it took you 1, 2, 3 trades and you're up 2, 3, or you know, you're up 2 or 3 winning trades, up $50, $100, $120, or whatever, what do you think the probabilities are that you're going to go 4 for 4, that you're going to go 5 for 5, that you're going to go 6 for 6? you have to imagine that the percentages of a losing trade, and do you notice how this just completely bounced off of that profit taking area? Guys, this is not rocket science. Demand to demand, supply to supply. That big topper, once confirmed that 200-day moving average, streamlined straight into the next level of demand and then immediately spiked. Well, how do you know to take profits? How come, how would one know to take profits there? How do you know you wouldn't be trapped? The people who are trapped here were the ones who were not expected to take profits at 17,886, 17,890. You know what I'm saying? If you just get into trades and you're just expecting them to just continue all day, you're dead before this even started. Okay? You're like you've got no shot. Not every trade is going to give you the same amount of points. You're not always going to make $100 a trade. You're not always going to make $500 a trade. Some trades you might take 30. Some trades you might take 300. Every trade is different, all depending on where the price is at. And again, if you're not one who can do that, right, where you can quickly identify and execute on these levels, get in, get out, then maybe you're not a scalper, and there's nothing wrong with that. Maybe you're waiting for some of these bigger levels to confirm. Maybe that fits more with your trading DNA, with your trading genetics, right? Everyone is different. Everyone is different. Don't have to scalp just because everyone's scalping. You don't have to trade the bigger levels because people say it's safer. You have to find what works for you as the trader, and you have to be all in. Okay, you have to be all in on that. Identify what type of trader you are and then go all in on that. Exactly. Right? So right now, what am I thinking? Well, if we take out this previous swing high, this previous wick from around 10 minutes ago, then maybe we trade up to overnight session high, 17,930. Maybe, right? And if it confirms and never gets there, where's your stop? Those are questions that need to be going through your head as you're looking at the charts. As you're looking at potential setups, as you're looking at potential, scalps, what is the plan? What is the plan? If it works out, what is the plan if it doesn't work out? If there's no plan and you can't identify it, there's no trade for you. You have to let it go. We don't get in on feel. We don't get in on feel. We get in on technicals because there's some sort of an edge. And again, remember, strategies, edges, levels, they're not concrete, guys. It's not concrete. I think the better you can be with being content with what the market has given you, the better off as a trader you're going to be. Like, for example, if you're still looking for trades right now, is that because you missed the open? Is that because you don't trade the first couple hours of the market? Is that because, what is the reason, right? What is the reason? For me personally, I've had this rule now probably for a couple of years now. The majority of my money, based on my stats and based on my back testing and based on what I'm looking for, the first 1 to 2 hours of the market, right? Now, does that mean I won't take a trade now or later in the day? Of course not, right? I've sat here through lunch taking trades. I've sat here coming out of lunch and taking trades. But the majority of my money is made in that first 1 to 2.5 hours of the day. So I like to tell myself, if I haven't caught a trade, if I haven't made anything in the first 2 to 3 hours of the market, what makes me think that I'm going to make money later on in the day? And If you have made money early, what makes you think that that money is going to remain in your account the more you trade? Because remember, this is not the more you trade, the more you make. That's not what kind of business this is. This is how good can you trade and how well can you protect yourself, keeps you in business and makes you money. Well, I haven't lost a trade yet. I'm up $300 today. I'm up $500 today. Maybe I can make 1,000, right? It's that kind of thinking that gets people into a lot of trouble. The trades will come naturally. It'll be organic. These things should fall into your lap. So also, as I'm watching price, what I tend to do is start to mark out potential scenarios as well. So, for example, if the market takes out this previous swing high, I would need to see price break 17,913. Okay, this is what I would want to see. 17,913. I want to see a new high be put in. I want to see a following candle either pull back or confirm that new high over 913. That would become the long position into 17,930. And then I lock gains. Okay. Now to the downside, I would need to see price break this previous 5-minute candle low, which would be a loss of the 20 SMA, 17,884. Once price breaks 17,884, needs to do one of two things. Needs to have a following candle pull back, go sideways, consolidate, bounce, do something, and or confirm that new low, which would be a confirmation of the 20 SMA play as well. And I would be looking to take profits into the next level of demand, which for me is going to be these overnight session lows of around 17,860s. Okay, that's where I would look to take profits into. Anything below 860s potentially could be pushing down into that prior swing low at 8:35 a.m., which is a price of 17,844. And anything below that, right? Anything below that, 17,831, which is that opening range higher low, or that opening range low day. So that's potentially how you need to start analyzing the markets, right? Draw out the scenarios, draw them out, have an idea where potentially can it go, because then again, that's where it goes back to saying that when I say let these trades come to you, the trade that you just went over mentally in your head, if it does start to confirm what you drew up mentally, that's what I'm talking about. The trade's coming to you. It's falling into your lap. You've gone through the scenario. And if it doesn't work out, you already went through that scenario as well. Where's my stop loss? What am I looking for? So it mentally makes things a lot easier. It mentally slows down the game. But a lot of traders will sit here. They'll just look at price. They're watching price. Market's choppy. They'll see the market push up a little bit. I'm going to go long here. Next thing you know, the market's pulling back. This is not working. They sell. They take a loss. They're going short. Market's bouncing. It's like you get into this habit of playing ping pong, like a hamster in a wheel going around and around and around and around. Don't get into the habit of doing that. Right now, price is a little pinned in between the 5 SMA and the 20 SMA on a 5-minute time frame.